Good afternoon, traders. My name is Britton Brown. I'm the founder of TradeHive. If you're not familiar with TradeHive or myself, let me just give you a brief tutorial about what's going on here. I created TradeHive to help retail traders understand how institutional traders trade the markets. Where the money is coming from and how they trade this is vitally important for you as a trader. I want you to be successful. I've been doing this for over 30 years. I was a pit trader. I started down on the floor, worked my way up. I managed institutional desks, owned a brokerage firm, made the transition over to the screen. And so I want to share 30 years of experience of how to be a consistently profitable trader in this market. You need to understand probabilities. There's a lot of stuff that's going on that you probably aren't aware of. So today I want to talk about the Commitment of Traders report. This is vitally important for your success, as I said, to know where the big money players are positioned in this marketplace. I'm going to show you, I post the Commitment of Traders report every single weekend for you guys. I cover the Nasdaq, I cover the S&Ps, I cover silver, I cover gold, I cover crude oil. I even cover Bitcoin. So with that said, and before I get into this, I just want to mention one thing particular that is really important to understand. We are in a huge range right now in the NQ market. And so understanding that we have no reason to go make new highs right now. I know we can get as bullish as we want to get, and we'll eventually go take those highs out. But we have geopolitical issues on the table right now. And every time we get into a premium zone, meaning over 26,000 in the NASDAQ, we have sellers coming in. It can look incredibly bullish, but this is exactly what institutions do. They get it as bullish looking as they can. They get you up into a premium zone. You think you're going to go make a new high, and they're selling to you. They're taking risk off the table there, and so that's, like I said, that's above 26,000. We actually settled this market couple really interesting areas. One, this year's VWAP starting in January 2nd, we are just underneath it, but we are also right above last year's VWAP. With that said, we are also just above fair value. That's the 50% level of this actually humongous range that we're in. So expect volatility. When we get into discount, that's going to be below 24,800. You're going to start seeing things look really bearish on your charts. Expect institutions to come in. And that's what the COT Commitment of Traders report is doing for you. Let you take a look at it. As I said, this is on my website every single weekend. This is the NQ. There's an ES and so on. As I mentioned, go through this. But I'm going to walk you through this. And this week and even next week is going to be really interesting for you. And the reason next week and this week are so vital to what's happening here is that right now we have reports that are conflicting with one another, meaning the NQ and the ES, right? That doesn't happen all the time. And so I oftentimes will spread the ES against the NQ or the NQ against the ES. And so these are things that I want to understand. Why is there more premium in one market and not the other? And how can I take advantage of that? And when the premium is going to actually come together, how do I take advantage of that? So with that said, on the NQ side, let's just kind of walk through this, and I'll finish it up with the TradeHive's risk regime index and how I come up with that, so that you understand how to best play this market into this upcoming week for the beginning of February. So what we have is, on the latest report, we have the third straight week of open interest contraction. Now, this is really important because dealers, those are the intermediary players, their open interest changed. They added 9,751 shorts back on. All right. So they are short, and this is dealers. They're predominantly in this position. They are net short 81,411. They carry 38,000 long. They've got short 119,000. That makes them the net 81,000. And like I said, they added shorts up in this area coming into. That was the highs that we were in. Dealers basically rehedged. They're preparing for volatility and downside risk. This is a shift on the COT reports that we've been watching. Asset managers, the institutions, right? They are net long 79,357. Basically, they're flat. They changed it. They took off 625 contracts. That's it. So institutions are holding firm. They're not exiting. They're not panicking. They're not dumping. They're just taking risk off the table at those levels. But they're always long, right? For the most part, you're going to constantly see them long, unless for some reason this whole market just falls apart, and then it'll be panic. But it takes them a very long time to even take those types of positions off. So understand that going into it. They're still in control. That's the point. The hedge funds out there, their net short 16,838. So they covered shorts, believe it or not. They covered 10,174 shorts. And this is huge, right? Hedge funds covered over 9,500 shorts, and they added longs. So that reduced their bearish bet. Smart money short covering into weakness. That's usually pretty supportive of the market. And that's why I said when we get into the ES, things are pretty much out of whack right now. On the retail side, retail's net long 13,405 contracts. They reduced both sides, so there wasn't really anything interesting out there for the retail side. They're being actually pretty smart. They're not chasing right now. So if you get onto the website, you can look at the flow from last week. There's a chart up there for you. In the last 3-week structural pattern, on January 13th, institutions were piling in, hedge funds were short, open interest was rising. January 20th report, open interest dropped hard. There was more hedge fund shorts coming into the market, and institutions were trimming their positions. And so now we have open interest dropping again and more covering, and the dealers hedging their positions. And so this is a transition phase. This is a regime shift from trend, range to decision. And ultimately what that means is the market is coiling up. Hence why we're right back near the 50% level, that fair value of this massive range that we're in. So it's not bearish, but it's more complex now. And so in a nutshell, the asset managers are still bullish. The hedge funds, they're backing off their shorts. Open interest is shrinking. And so this is kind of what we call late consolidation, pre-breakout structure. One way or the other, we're going. So we could either squeeze higher, or we could have a fast liquidation flush and then some sort of a rebound. So with that said, let me get over. There's more to this. Like I said, go check out the report. It's going to be vitally important for your success, especially where this market is right now. On the S&Ps, open interest is sitting over 1,897,000. And so that's pretty interesting. Weekly change is down 29,000. What does that tell you? Risk is coming off again. So after last week's re-risking, this is another position reduction for the week. And so you need to know about that. The dealers, those intermediary market makers right now, their net is negative 668,000. The weekly change, they added 956 on their long side, and they added 5,718 contracts to the shorts. On their spreads, they're minus 997. What does this ultimately mean? It means dealers are adding shorts again. They're reducing their spreads. They're rebuilding downsized hedges. So they're a little bit concerned and of the risk of instability in the marketplace. The asset managers, that's the real money. All right. They are long over 1,103,000 contracts, short 191,000. That makes them net a positive 911,000 contracts. The weekly change, they added 3,451 of the longs. And on the short side, they added 15,783 to that. What is the interpretation? Institutions are adding longs, covering shorts, increased net exposure. It's a quiet vote of confidence for this market. in kind of a bullish confirmation. That's why I'm saying, like, we've got all these different things that are not jiving with the S&Ps and the Nasdaq. So that's why I said there's going to be more volatility. Leverage hedge funds out there, the CTAs, they are basically short 538,000, long 111,000 plus, makes them net short 427. And basically, what that means is the hedge funds re-shorted this market. The previous week, I'll kind of cover this real quick. They were taking some of that off for that move that we came up into, and then they started re-shorting this. So the closed spreads returned to directional bearishness. They tried to flip it last week and failed. So now they're re-entering some of that, the hedge positions that they took off on that run up. So let's see, on the retail side, longs added, shorts covered, retail's optimistic again. This is now a conflict of regime. Basically, long-term money still long, fast money is still short. Dealers are hedging, open interest is contracting. And so that's why I say this is getting kind of crazy as far as trying to have any type of trend. It's not happening right now. So intraday scalping is probably the play. Just again, know your environment. If range breaks, that's fail. The VWAP magnets, stop hunts, both sides, New York open reversals, power hour squeezes, and avoid chasing any kind of third push moves and late session breakdowns. Bottom line, institutions are calm, hedge funds are nervous, dealers are hedging, market is unstable. So with that said, let me get into the TradeHive Risk Regime Index. And basically, there's 5 core regime factors to putting this index together. We want to know who's in control, who owns price, and we get that from COT. We want to know who's trapped, where's the pressure. We get that from the COT report. Where are we in the cycle? Are we early or late? Is open interest in the trend working for us, or are they starting to take things off? Is the trend actually that we've been in slowing down? Of course, that's what we're talking about. And then on the leadership side, who is leading? NQ versus the ES. And then liquidity-wise, is money entering or is it exiting? And so as we put that together, we have the index, TradeHive's Risk Regime Index. And currently, as of week ending January 27, 2026, our composite score is a -2. And so that's what that means for us is a volatile transition. Control, we gave it a 0. Institutions are long, dealers are hedging. On the pressure side, we're pretty balanced. That's a 0. So positions are coiling for a big move. The cycle is late, so that's a -1. Open interest is contracting. On the leadership side, there's divergence, right? That's what we're fighting. NQ's leading, ES is hesitating at these levels right here. So on the liquidity side, it's weak. That's a -1. That's capital reducing in the marketplace, and that's how you come up with a -2. Recommended trade mode is being defensive, selective execution. And what that means for you traders out there, focus on liquidity sweeps, VWAP fades, expect fake outs and sharp reversals, reduce position size, take profits quickly, avoid breakout chasing, and avoid emotional bias regime shift triggers. Ultimately, like I mentioned, this week, our risk regime index is -2. That puts us in a volatile transition. So I'm not going to be pressing trades. I'm going to be protecting capital, and I'm going to be trading the edges. That's where the money's going to be made, and reducing my risk is the main call there. So keep that in mind this week. Every morning, I will put out my playbook. I give the playbook out for free on the website. Again, that's tradehivecommunity.com. You'll get those. Most of the time, it's the NQ or the ES. I do cover gold. Obviously, gold got whacked. I mean, $1,000 pullback. Silver got smoked. Those were big moves. Crude oil seems to be pretty bullish right now in lieu of what's going on. Bitcoin got hammered on Saturday. I don't know if you saw that. So there's a lot of craziness going on in the marketplace. So I think I'll probably lead with the NQ report on or tomorrow morning. That will be February 2nd. So look for that. And again, I post these so you have something not to give you a bias, but to check your bias. Is my bias in line with yours? Do I give you some information that maybe you didn't think about that could help you with a winning trade or a profitable day or week? That's what it's all about. My main concern is I've seen a lot of the videos out there, and they're just not very helpful. And when you look at prop traders or these gurus online, there's very few people that are consistently making money. They don't understand probabilities. They never talk about where institution flow is. And that's where retail traders make their money on a consistent basis. And so that's why this is so important. Enjoy all that stuff, man. Get into it. I've got a great video out there talking about zero, gamma, delta, how these market makers really trade. I know that most retail traders think that market makers are running their stops. That's just not true. That's not the way it works. And believe it or not, market makers go bust too. And so this is a difficult market, but you got to know all the facets of what's going on, where order flow is, right? You need to be looking at where the institutions stacking their trades. I wish you all the best. Like I said, enjoy those free reports. If you have any questions, you can leave a comment on this video for YouTube. You can certainly contact me through the website. I'm always here to help you. Appreciate your time.